There are some who are suggesting don't wait around. Like they're already switching their allocation mix way heavier in bonds, for example, and lighter in equities. And you've had many firms take down their exposure, take down their outlooks. You get Barclays today. Markets are underpricing trade risks, switch preference to global fixed income over equities. I mean, this is your wheelhouse here.
So there's something really interesting, and this is a pretty historic point in time. Normally, you think about, gosh, I got to go to cash. I got to get really defensive. The beautiful thing today is you've got a central bank, you've got the Fed, and by the way, the ECB, that hasn't hit its inflation target. So you keep the front end of the yield curve high. What that allows you to do, you can build a portfolio with pretty safe fixed income, create 6.5, almost 7% yield. And so think about what that means. If you're on a pension fund, an endowment, foundation, my return target by and large is around 7%. And inflation, let's say inflation's running high twos. We could debate which metric we use. Gosh, if I can hit 7, I've got operating income I've got to manage. Inflation, that gets me a pretty attractive real rate relative to anything we've had over the last couple of decades. So we are seeing some of that shift. And I think that's real. And I think you'll continue to see that income. And by the way, it's also a historic point in time because post-COVID, companies, consumers, financial institutions delevered because rates were so low, so they've termed their debt out. So you've got actually a structurally good time to invest in these asset classes. So it's a pretty neat. So you are seeing some of that shift. By the way, I don't think it necessarily means if you've got a lens longer than a week, a month, 2 months, you should get out of equities. I think there's some great stocks, a bunch of which have been repriced down. I just think you got to manage your near-term beta a little bit and then think about, gosh, what are the stocks I'm going to hold, and I'm going to hold them for a longer period of time.
Like what kinds of stocks? If you can't talk about individual names, like I know you probably can't, don't want to, but when you say that, what are you referencing?
So listen, I think at the end of the day, you've got to take, so technology is a great place to invest in equities. But you think about today, you talked about AI. By the way, I think it's extraordinary where we were a month ago or 2 months ago because markets can only do one thing at a time. And then all of a sudden the sentiment changes. But I think you broaden out how you think about it. Who are the companies that utilize data effectively that are maybe broader than the mega cap? And so look at some of those companies. The healthcare companies, I think, are super interesting around where you're using data effectively. Financials, I think, by the way, not just U.S., Europe. I know they've had a great run into some of these European financials, some of the European banks. But you look at the multiples on those banks, if you believe that Europe's got some infrastructure spent, some of those multiples, even with the rally, are still pretty attractive. So I love the idea of doing that. And also, for the first time in years, diversify a bit more internationally. That, by the way, including Asia, where there's some opportunities. It's just as I think the U.S. is going to be a little bit more uncertain than we've been used to. And, for the first time, U.S. economy, we could have a transition that administration's comfortable with because we got to bring the debt down and we got to do a number of things in the country that maybe we can just transition a little bit. Maybe I can hide a little bit internationally while that plays out.
Well, there's a lot there. I mean, you used the word transition just now. Is that what the Treasury Secretary refers to as a detox? And we've already come down 10% in the S&P. We had a decent bounce, but now we're a bit unsettled again. Was that enough of a pullback? And to my first question, I mean, is that what you're referring to, that this is going to be, the transition has the potential of being somewhat painful?
So, I will say one thing, and I won't interpret how anybody describes this, but I will say one thing. I've said this on the show before. What is the biggest risk to the system? We have too much debt in the United States. We've got to roll over too much debt. We got to bring spending down. Oftentimes that requires a recalibration to do it. We've got to create a better runway around where we are in terms of our spend in this country, bring the debt down, get the cost of the debt down to create a more durable dynamic that, by the way, you'd feel comfortable with the currency as well. So those things can require a little bit of a transition. By the way, things like the spend in parts of healthcare. We talked about there's some parts that are pretty darn stable in things like robotics, data-sensitive companies. But the amount of pullback you're going to see in some areas that got funding from the government, whether that's hospitals, whether that's parts of the education dynamic, that, by the way, have been huge hirers of people over the last couple of years. So you see a little bit of pullback there, and I think you'll see that in the payroll data over the next couple of 3 months that you'll see all of a sudden, what was it, 42% of the jobs created for the last 3 years have been healthcare and education. Think about the funding dynamics, how that's transitioned. That's going to be different going forward. 22% have been leisure and hospitality. Immigration solved a lot of that. You're able to operate restaurants, hotels at full capacity through immigration. That's changing. So there's some things that are going to evolve that are going to be quite different than we saw over the last couple of years. And we got to watch that play out for a bit.
Have you raised your own alarm bells on recession?
So I think I think we talked about last time we were on. I think the error bands have to move out a little bit around how you think about growth, how you think about what's the transmission of tariffs into inflation. And I'd say a couple of things. What's happened is companies sitting on their hands. I'm pretty confident the consumer will pull back a bit here, but consumer will be fine. What in the near term, the reason why I think you have to increase the risk of a slowdown to a higher proportion today or to a higher part of your calculus is companies are going to sit on their hands. If you think about CapEx, you think about R&D, you think about M&A. If that's going to be postponed, then, and by the way, you're talking about a big amount of growth driver of the economy, then I think you got to say, gosh, we may have a quarter or two that are slower than originally anticipated. By the way, we came into the beginning of this year, it was all about animal spirits, and it seems like it's moved to animals in hibernation from animal spirits, and that can translate into a bit slower growth for a couple of quarters.